All right, so today I wanted to talk about liquidity. Okay, now I would use my iPad. Let me just double check whether my iPad is charged or not because I just came home. Do I have charge? Oh, I do. Okay, so let's look at the iPad a bit. All right, I will talk about liquidity. Actually, it must be not in the iPad because it's obvious concept. Because I feel like y'all would learn better or I would take it in better if I show chart examples more, right? So theory, it's only for the iPad. Practical example, we look at the charts, right? So let's make this session as practical as possible for the guys that are not here and for the guys that are here. Okay, so you can ask questions as well. Let me just type it all down. All right, so number one, we have to understand the logic, right? So again, this is kind of the basics, but let's do a little bit of a refresher. It's always structure first. Okay, so structure is always first, liquidity is second. Okay, now there will also be a point of time in which liquidity is first, and structure is then second. Oops, second, right? Now there's going to be certain times in which the first scenario is true, certain times in which the second scenario is true, right? Now, in order to understand that, what we need to look at is external range liquidity. Now, when we talk about external range liquidity, now the way ICT says it, it's very vague. Okay, he says, okay, that's the external range, it goes back inside, that's the internal range, therefore it drops to, therefore it goes higher. But then there are certain liquidity pools that are classified as only being external range liquidity. Okay, there are only certain liquidity pools that are classified as being external range liquidity, whereas the rest of them are internal range liquidity pools, right? Whereby the rest of them are internal range liquidity pools, right? So what do we mean by external range? Now, obvious. Now, we have been taught, okay, we have been taught that external range liquidity is literally any height. This could be external, so we can get internal reaction there, external. It's wrong. Okay. What is the range we're working with? This one, this one. What is all of this? Internal range liquidity. It's internal to this massive range. Okay. This high to this low. It is external, correct? But it is external to what? It is external to these internal liquidity pools. Okay. It's external to these small internal range liquidity pools that exist inside of this high and this low. The range is this one. The range that we're working within right now is this one. Okay. We had SMT here with Ethereum. Stop hunt. Displacement that I like to see, which shows that okay, there is a breaking market structure, there is a shifting market structure. SMT shows that okay, you know what, probably it's not going to go higher than the imbalance over here. Therefore, it's okay to sell from over here. That's what my understanding is. Okay. What am I doing? Or what am I looking for? At this point of time, right? If you go to the left, this is the previous day, 6 o'clock CLS opening. Sorry, and 6 o'clock previous days. Previous day's price action is okay. It's to the left. It's to the left. Okay. So now what we're looking at is here. Here. This is after 2-day close. Okay, this is after 2-day close. So if it's after 2-day close and price still kept on raging on lower, what does that mean? If we are taking out a previous week low, which is over here, and price rages down, we are bearish, right? We are bearish. You see, we are bearish. What's this? External range liquidity. Again, I'll come to what external range liquidity actually is. Okay, that's external range liquidity. What's this? External range liquidity. What's this? External range liquidity. What's this? This is pseudo liquidity. Now, when I say pseudo liquidity, it can be used interchangeably with external and internal. What is the reason that a session high and low What is the reason? What is the reason for that to be considered as external? Because it was formed inside a time of day in which large funds, central banks, high frequency trading algorithms, blah, 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 all of those things, right? Where they had vested interest in keeping these highs, this high rather, protected. So if this high is protected, now here's a small Q&A for you all. If this high is supposedly protected from the previous session, what rests above these highs? Now I'm looking for a very specific answer, okay? What rests above these highs? Question mark. Don't be shy, come on. Orders, okay, but I want something more. Something else. What about the magnitude of these orders? Is it big or is it small? Are they large volume orders or small volume orders? Yeah, buys are liquid large, right? So they are large pools of liquidity. They are large orders with either in terms of high frequency, not high frequency, intraday stop losses. All right, buy stops. That's pretty much it, right? So stop loss and buy stops over here. That's going to be large. It's large in terms of its magnitude, its size. So okay, let's say a hypothetical example: price comes and takes out this New York high over here. Okay, takes out the New York high. What's happening? Let's use an example, right? So over here, let's say that price is going up by, let's say, a magnitude of 100. Over here from the previous day's New York high, let's say there's an orders worth about 90, minus 90. Okay. So then when these 100 orders over here are neutralized against opposing orders, what's going to happen? There's a netting effect. There's a netting effect whereby there's only 10 orders left, or there's an order size worth only $10 left. That's not enough to move the market. That's not enough to cause price displacement in any way, right? What's going to happen is this. If these positions are neutralized, okay, and these buys are neutralized with, or buys are to be neutralized with sells, right? If these buys are neutralized with a magnitude of a sell of 90, of a large amount, let's say, what's going to happen? There's going to be a sizable displacement to the other side. So that's giving you your bias. Okay, you understand the logic behind it. Let's make it simple, right? Big orders. Price takes out big orders. Therefore, price needs to go to the opposing side. Now, in returning to the opposing side, what's going to happen next? What is price going to be looking at? Are there relative equal lows? If there is relative equal lows, then what? It's literally a straight path down there. That's your directional bias. That's your bias of being bearish. Upon taking these highs out, what if let's say there is no equal low? What if there's a strong low? Let's say this is strong. What's price going to do? Okay, we're going to get a sell down here, then we're going to get a buy back up. That's bullish. Short term bearish, medium term bullish. That's how we get our bias. Okay, so now the important part. Now the important part is this. Your external risk liquidity pools, right? It's like this. That's my text box. Here. External risk liquidity, right? What's the order of things? The order of things is like this: previous session high, previous session low, previous day high, previous day low, previous week high, previous week low, previous month high, previous month low. Okay, all of these bad boys and girls are your external range liquidity pools. This is where you are going to get your retracements, or the start of your retracements. This is where you're going to get the start of your long ass reversals. Or let's say you take out a monthly high and low, it could be a retracement on that time frame, but on lower time frame is one massive reversal, right? You can play with that order flow. You take previous month's low, okay? There's going to be what? It's going to look like this, right? So previous month low taken out. What happens on lower time frame? Let's say 15 minutes. 15 minutes shows this, bro. You can buy all the way up into that range there. So that's like almost 1,000, 2,000 pips, depending on the asset class. So, right, if it's gold, it could be like 10,000. I'm exaggerating, but you get what I'm saying, right? So by looking at things like that, you'll be able to determine your bias. Then comes the next part. So this is the basics, right? This is the basics. What do you want to see? You want to see price rating a higher low. Okay, that's going to give you a directional bias. Now, what if, moving to the next part, what if price has already done that? So let me take you to Euro USD. That was a good example on Euro USD yesterday. Okay. Yeah, so yesterday I was operating based on that fact. No, I wasn't trading it. I was talking about it to you guys on the live session. Okay, so this is the starting time here. Asian high taken out. See, Asian high taken out here. What's that? Previous session high. Previous session high taken out. What happens? Price drops. Why? Because Asia, there was some, obviously there was some large orders here, right? That led to the displacement down here. What happened here? That was a sell. But here, look, but what exactly happened? Look at the storyline. Okay. High right here. Higher high, breakdown. We take out the Asian high, which is inducement to what range? Inducement to this range. Induce, that's your reversal. What gave you the idea for being bearish? Number one, high, higher high, breakdown. What is this? Bearish interbank dealers range, right? So the reason I don't talk about this anymore is because it should be in your head by now. Okay, bearish interbank dealing range. Number two, next day, what's this? Asian highs, relative equal highs. Okay, price takes it out and price rejects down. What does that mean? Previous session high is an external range liquidity pool. So given that the context is bearish, context for this is also bearish, this order block is a sell. Okay, this order block is a sell. And you don't even touch anything. So you're going to keep on being a seller, right? Until this one gets taken out. Until previous day's low gets taken out. Okay, I'm going to be a seller from up here all the way down here. Then what about these moves? See this up move, this up move. What about that? Okay. This is the previous day. This is the previous day. Right? So now look at this day. Look at this low. This is the, I think it's the New York, yeah, previous New York low. All right. So previous day session low is right here. Previous New York low is right there. What happened? Price took it up. Look at this move. But why isn't it breaking all the way up? Because context is bearish. Bearish in the bank dealers range, inducement of previous day's Asian high, and price is yet to take out previous day's low. Because now, in order to be bullish, we need to take out some important liquidity, right? If we were to be bullish from here onwards, then what do you want to see broken? That, right? That. But we didn't get that. So we're bearish. Then come down here. What about this? That's midnight, so we don't care about that here. This is London low. What happens? London low taken out. Here's a buy. To do what? Fill in this imbalance, come into the order block and sell off again. Is it? Oh, nice. Okay, so that's the supposed algo structure you keep on hearing about these days on Instagram, right? External lows, nothing new. Only ICT did not mention it in a way that's easy for everyone. Right? It takes either losing real money or blowing multiple demo accounts and then having it click for you. Okay, that's how you get. That's for sure. That's how you get. Or having a mentor who has been through that shit so that you don't have to go through it, like me. Okay, so money was lost. Just to know this simple fact. It was clearly given to us, but we didn't know what to do with that until it was too late. Okay, midnight low does not count because it's just midnight. It's not London. Okay, so this low taken out, and here's your move. So there's a reason for every move, right? So here's a reason here. Here's a reason here. This is internal, and we go down. Okay, now what happened? We took our previous day's low. This day's low. What's that? Ton of money, ton of sell side liquidity, right? What do we want to see? That's the question. Now here's where you have to use your brains a bit. What do you want to see? If we are going to reverse from previous day's low, okay, you need to see at least this high get taken up. Why this high? Because see, this section of price action led to a new low being created, right? So we want to see this high get taken out with nice displacement there. It would be helpful. It would be helpful to have SMT so that we know that, okay, you know, it's confirmed we're going to go up. Here's a buy. And now, because there's a buy from the previous day's low, we know that, okay, you know what, daily chart is probably going to flip to bullish. If I look at the daily chart and I'm bullish, obviously, I want to see the next candle's high get taken out. So what are you going to do? Well, buy here, take profit all the way up here. So like just like that, you have a massive ass trade. And while knowing that the order flow is bullish, right? While knowing that the order flow is bullish, guess what? You can segregate the time again. So let's look forward in future. Okay, here, 6 o'clock. Now, with regard to this day right here, okay, what do we have? Let's see. Let's find New York. New York. I think it's this one, right? Yeah, here. New York high is over here. Okay. So let's say you go here, you buy. Go up over here. Fine. Here's an imbalance that's left to be filled. Okay, you sell. Sell down there. Obviously, there's going to be imbalance over here. Buy back here. And you add to your first buy, second buy, you add to your position until price goes up here. Okay, so it's all about real liquidity. So now again, I said, if we go back to Bitcoin, my thingamajig's over there. Okay, here I said structure first, liquidity second. Okay, over here, structure first. Why? We took out previous week's low. That was liquidity, right? But does it go higher? No. So liquidity first, structure second doesn't work because structure does not support that bullishness that we're looking for once price takes out a low. Okay. Now we are in between previous day's high, previous New York high, and we took out all of the other previous days liquidity pools apart from the previous day's low. Right? We took out everything apart from the previous day's low. So we are in between. So now when we're in between like that, what are we going to follow? Structure first, liquidity second. What is structure showing us? High, massive drop displacement. Sorry, high, we try to displace low, okay. And then we are slowly, just waiting. Followed by SMT, displacement, return into the fair value gap, and now I would like to see price drop. But what makes me kind of, you know, icky towards this setup? The fact that this failed to take out this low. Okay, the fact that this failed to take out this low. So due to that, now when I see this imbalance being filled, I don't even know if it's an imbalance. Let me check. 5-minute chart. Yes. So this imbalance over here, this imbalance is being filled up, right? So when I see this imbalance being filled, when I see price trying, you know, taking out these highs now, what am I going to do? Immediately cut my losses to something like this. Something like that. I'll do something like that. Okay, only and only if price starts to go back higher than this or higher than this high. Then I'll just cut it off at break even and I'll look for an opportunity later. Because if it has to go down, it has to go down now. Okay, so that's how I look at things. The reason that this setup here, while it is high probability in terms of SMT, displacement, fair value gap, imbalance, you know, all point to the downside, the only thing that does not support it is liquidity, right? Where is that buy side liquidity to give us that juice to go down? No juice nowhere. Only juice is up over here and up over here. right? What's this? It's 6 o'clock, so Asian high is up here. No, wrong. 6 o'clock is here, my bad. 6 o'clock is here. Okay, 6 o'clock here. That's the Asian high. Asian high is over here. Suppose the Asian high for a weekend, okay? I'm just saying. Formed over here, price takes it out, price drops. Okay, so previous session high taken out, external, price drops. So this is liquidity. But we need stronger liquidity from the previous day. Okay, while this is enough to support this move down, so this move down already happened. This move down already happened. So in order to support any further move, I personally want to see previous New York high, previous day high, previous London high, something like that. I want to see those get taken out because those are the external risk liquidity pools that will be used to fuel a move in the opposite direction. Okay. Now let's talk about context. You have all these external range pools here. Okay. You can see that, let's say this is a previous day high. Price takes it out. Okay. Price takes it out. And now upon taking it out, you don't want to see price come back up there and go higher. Because the moment price does this, right? Previous day's high over here. You get the point, right? So previous day's high over here, price takes it out and goes back higher than that. Then what happens? Then the previous day's high is going to be used as support. All right. Previous day's high is going to be used as support. Price is going to work off the range over there and go higher. So what does that look like in the form of a candle? In the form of a candle, it looks like this. Show it to you on GBP. Because it happened in GBP. I think it was a daily. Yeah. Okay. See this. I was prepared to sell as it went up over here. Came my way. My take profit was here. Came my way and see, boom, went back up. So the moment it crosses this high again, this is natural support. Okay, this fellow is natural support. So let's go to the 15-minute chart. Let me first mark that out. Right there. Okay. This one. So price takes this out right there. Okay. So here was my sell. It came down. I sold over here. Went my way and then boom, other side. Okay. Here we use the previous day's high as support, fills in the imbalance. That's all good. Okay. All good. And it goes higher. Then proceeds to go higher one more time. So that's like, preparing you for the next day, sell off. Okay, so that's one example. Previous day. So it's fractal, right? It can be previous week high, it can be previous session high, all of that. And that's how you know, okay, you know what? This is not going to go any lower. It's just going to go higher. Okay, so it's going to go higher. And it's choppy also. So I personally would not take it because of this choppiness. Then from here, daily chart again. There's a high there, right? So that the sell that I lost yesterday was based on this. We took our previous day's high, all right? I took a premature sell over here while the sell was actually supposed to be here. Took it over here, it stopped me out, went down. So, and then obviously proceeded to go to my take profit, which was that day's Asian low. Or was it? It was a projection. Let me just double confirm. That was a projection of 1, 2 here. Okay, so we'll come all the way down. Right, so took our previous day's high. All right, took our previous day's high, and then what's that? External range liquidity. What's happening? It immediately runs away. So when it immediately runs away like that, I had the confidence to say that, okay, you know what, I took our previous day's high, it's running away. There was SMT over here suggesting that, okay, that high was used as a stop hunt or a stop rate, and we come back to the accumulation zone and we sell off. Okay, so this was the move I want to see. It happened perfect. Okay, it happened quite perfectly. Very beautiful man. All right. Consider this. Let's partition the days. The days. 6 o'clock, 6 o'clock. Okay. See, okay. Price goes down. What's this? Previous day New York low, 7 o'clock. Previous day New York low, price takes it out, goes up. That's a buy. That's a buy in this day's Asian session. It's a buy. Okay. What's this? London low. One of London's low, right? Takes it out, retraces, and this drops. That's fine because there's an imbalance also over here. So that's a justifiable buy. What's this? This is the actual London low. We're yet to reach that. Okay. We are in a sell program. So the sell program suggests that we should be going for low resistance liquidity. Where's low resistance liquidity? Here. Why here? Consider this here. What's this? Someone tell me. S what? Oh, Bitcoin going higher. It's what? S what? S what? What's those symmetric lines I drew? Not symmetric. What's the what was that pattern I drew? SET here, right? Symmetric channel, trend line, liquidity. Right. So with this being symmetric channel trend liquidity, let me just quickly reduce the one in half. Bit more. So half stop reduce, risk reduce, and we see how it goes. It's symmetric channel trend and liquidity, right? So targeting, you can either use projections or you can use liquidity. So this will be my final target. By projections, projection base would be somewhere just below over here. It's still kind of similar to this, right? Because liquidity over here, liquidity over here. So this is your final liquidity pool to look for in this move. Okay, so final liquidity pool look for in this move. So we have 1, 2, 3, and just to get to 3, we have to take this out anyway, right? And at 3, what do we have? We have a weak imbalance over here, which I wouldn't consider as of yet. Okay. So that is how we use this, right? So that's the context. The context is thinking about liquidity, thinking about where price is with regard to liquidity, checking to see whether, okay, am I supposed to look at structure now or am I supposed to look at liquidity now? If price takes out a liquidity pool, external range liquidity pool in terms of, let's say, previous day's high, then what does that mean? It means liquidity first, structure second. Price takes out the high, okay, that's liquidity first. Structure second, meaning, okay, now I want to see bearish structure, high drop. SMT to confirm the accumulation, or displacement showing that there is willingness by supposed smart money to take price or reprice lower, or for the algorithm to reprice lower, right? So if I were to summarize things, I would say no rate, no trade. Okay, no rate, no trade, no displacement, no tradement. All right, so no displacement, no tradement. Here displacement, here tradement. Okay, have SMT, accumulation, have trade. No accumulation, no displacement, colors, no trade. Okay, the reason why I move my buy over here to break here was because I perceived which one? I perceived this as a nice move up, which was pretty good. But then the following movement of price was useless, right? So this is not what we want to see. We want to see nice, healthy moves like that. Okay, especially after taking out a high. Sorry, after taking out this low. Here we want to see displacement all the way up there and then sell off. Okay, so the fact that we could be selling off now means that when we take out this high, when we take out this low, that's going to be a buy. So you want to be buying below previous days, not previous days. I would say you want to be buying below higher time frame lows, and you want to be selling above higher time frame highs, which is the way to go about it. Okay. Now that's the external range part. But what about the internal range? I'll make this quick. Okay. No SMT. Let's say no SMT here. We broke here. We continued breaking here, right? What's this break? A body break. If it's a body break, what are we looking at? 50%. Okay, 50% as a place to react from. Then if we use something else, off record stuff, we understand that this was a low, this is a low, and we broke that high resistance pool. Then what are we looking at? 35%. But what trumps all this? What trumps all this is the fact that we have SMT, accumulation. So accumulation zone plus imbalance is the way that I would choose to go. Yep, that's the way. That's the only way I would choose to go. Go this. Right. So to summarize, you have SMT, right? No deep retracement, or let's say less minor, or how can minimal retracement. Okay, so minimal retracement, no SMT, deep retracement. Deep retracement relative to the range broken. Okay, deep retracement relative to the range broken. That is how you'd go about it. Also, you need displacement. Okay, these are the two ways to go about looking at price action in terms of structure, liquidity, and all that. Okay, and you have to always keep in mind that we are working with 1, 2, 3. Okay, so 1, 2, 3. 1 is the manipulation. Let me write it down. 1 is the engineering of liquidity to be manipulated. 2 is the manipulation of 1 and rate of liquidity into PDRA or imbalancing thing. Number 3 is where you look for what? Inducement, return to range, balance fill, basically your entry swing. Okay, this is as simple as I can put it. Number 1, engineering of liquidity to be manipulated. So yes, you can trade the buy up over here to by using the lowest of the lowest time frame. Okay, number 2 is rate of external range liquidity into fair value gap, into PDRA matrix, into same thing. So into one of the elements of the PDRA matrix, which then forms, if you are lucky, SMT between 1 and 2. Right? This portion is your entry portion, where you focus on the entry on the right side. This is your context. This is your entry. You use everything that you learned so far, right? What did you learn about the first one? Small bodied candles, nothing big happening. No, not much of volume in the moves. What about this? Sudden volume ups to the upside followed by sudden volume to the downside. What's that? Manipulation. So what can we get out of that? We can get directional bias, we can get accumulation, whether it's accumulating or not. That's pretty much it. We can get all of those pieces of information from from the second swing or second swing point. Third swing point is what? What are you going to use? You're going to use every single damn thing, you know. You can use inducement. Okay, was there short-term high over here to induce? Then you can say, okay, at this point over here, at the portion in which price took out liquidity, is there bearish order block? Okay, fine, that's my entry. If there was SMT over here and there's an accumulation zone somewhere here, do I have an imbalance over there? Okay, fine, that's my entry. Right? Then if price took out a high resistance liquidity pool as it was dropping down, I'm going to be looking at the I'm going to be looking at range valuation to check points of interest for me to enter from. Where is that? 75% over here. That's my entry point. Then what else can I say? Then using a much more simpler approach, if price had a wick break in market structure, meaning there was a body closure down, as well as a body closure down, meaning a body closure below the bodies of these candles, plus a liquidity, I'm going to be looking for price to return near the stop 100 portion. So that's also my entry point. Okay, so you have everything. So context and all that good stuff is from the first and second leg. Your entry is from the third leg. Okay, that's your swing point. So the third leg is the most highest of the highest probability of trades. How so? See, 1, 2, that's 3, 3. Down we go. 1, 2. This should be 3. If not, then I'm wrong and it should go up somewhere here and that's all. So based on what I know, SMT over here, accumulation zone is somewhere here. So let me show it to you guys. The accumulation zone is over. So this high takes out what high? This high. This is accumulation zone here. Okay. Now from this range here, I want to look for a high that has been manipulated once and a low that has been manipulated once. So this high, sorry, this one here has been manipulated once over here. And what was the last low that was manipulated? The last low was this one over here. See, it was manipulated over here, right? So that is my accumulation zone, right there. Inside my accumulation zone, where's the imbalance? Here. Price went into it and price nicely went away from it. So now what do I want to see? As per my observation, as per my experience, I want to see price start to slowly move towards the low. Now the reason I'm saying slowly is because we are not trading inside of active trading hours, right? It's the weekend. So it can take all the time at once. It can even hit my stop loss because there is no logic behind it. Right? There is no active trading involved. So there is literally no one in the markets Saturday and Sunday actively seeking for liquidity to get out of their positions. Unless, of course, something happens in the crypto market and some fellow wants to dump everything, then, of course, this will just accelerate to my take profit. So there's literally nothing going on today. That's why small moves inside the range, right? We'll probably see something tomorrow because normally Sundays or Saturdays, one of the 2 days during the Asian session timings, we see large displacements of price. But today it was very slow. Still, even though it's slow, doesn't mean you can't catch moves. It's like 1 minute time frame moves. But the only reason I can't participate in that is because of the spread. See? What's a massive spread? See, massive. So I don't like that. So I'm focusing on 15, 5 minutes, something like that. You'll understand today's session. This, for the guys that are watching the video also, this is as simple as it gets. Now you have the ability, I mean, you always have the ability if you're thinking hard enough. This is basically what you should be looking at. What does the first swing do? What does the second swing do? Once you see that, okay, the second swing has formed, easy. Just go ahead, look at 30-second chart, 15-second chart, 1 minute chart, look for a fractal, 3-bar fractal, enter on the third bar, and enjoy the move down with the tighter stop, which I don't advise doing because sometimes spreads will screw you up. So, yeah. You'll understand or what? If you all do understand, now we can open up Q&A. If no Q&A, then we can go and you guys can backtest whatever I gave you guys today, or you can watch the video again after I upload it. So let me know soon if there's anything I have to go through. I shall be waiting. I'm going to mute myself a bit, so just let me know. Just say yes or no. Yes being you want to ask me a question. No being you're done. Okay. Alright, so guys, I'm going to take your silence as no questions. So if there is no questions for today, I would advise you to go through these. Okay, so this one over here is for your own model creation. I know I said we'll talk about model creation, but go through this first. Tomorrow we'll definitely talk about it. Okay, 100% though we shall talk about it tomorrow at 9 a.m. EST, so normal time. Think about this: structure first, liquidity second. Liquidity first, structure second. External range liquidity, internal range liquidity, what we just spoke of. And previous session high, previous session low, previous day high, previous day low, previous week high, previous week low, previous month high, previous month low. Important for determining bias, intraday bias, intra-candle bias, intraday bias, intra-week bias, all that. Yeah. So since no one's up for questions, I guess that's all for today, guys. See you guys tomorrow, 9 o'clock. All right. So bye-bye. Have a good day.